Good morning, everyone. My name is Patrick Malcolm. I'm a senior partner at GFM Wealth. I hope everyone is well this morning. It gives me great pleasure to be able to present to our clients today the Magellan Infrastructure Fund, which we have presented to clients both in 2021 and 2020. Just to give everyone a little bit of background on the history of this strategy, this fund has been running for 15 years, which has been a pretty difficult 15 years when you consider it pretty much included both the global financial crisis and COVID as well. But since inception, this fund has a very, very impressive track record. That track record is of an annualised return of 7% per annum compounded, whereas the benchmark has only returned 5% per annum. And as I always say in these webinars, I do get a little bit frustrated as to the industry's obsession with annualised returns. The 2% doesn't sound significant, but compounded over 15 years, that equates to a compounded return of almost 180% versus only 100% for the benchmark, which is extremely impressive. And as we focus on a lot at GFM Wealth, the downside characteristics of this fund are very impressive. In down markets, this fund only captures 64% of the downside of the benchmark and significantly less than the global share market. So this is a perfect investment for the purpose of diversification. So I'll introduce Gerald Stack in a moment. Gerald's got a range of educational qualifications, which includes an MBA, and like all good fund managers, he's a chartered accountant. He started the fund back in 2007. The Magellan Infrastructure Fund has $16 billion in it. So it's a very, very big fund. So thank you for joining us this morning, Gerald.
Thanks very much, Patrick. It's always delighted to join you guys.
Thank you, as always. Now, as always, we do need to show our disclaimers, which I will get through. So, as always, this advice is general in nature. So if you have any particular questions about this investment or how it relates to your situation, please call the office and speak to one of our advisors. As always, why have one disclaimer when you can have two? There's a Magellan disclaimer there as well, Gerald. So thank you for joining us today. I think the elephant in the room would be just to get out of the way with maybe a little bit of discussion about the recent leadership changes at Magellan. Gerald, I know you manage the infrastructure fund, but you're also involved with Magellan at a corporate level as well.
Yeah, absolutely. So there's a few things that have gone on this year. Firstly, Hamish Douglas, who was CEO and CIO and also the lead portfolio manager on the global equity strategy, he took some medical leave earlier this year and he's elected not to come back to Magellan. He remains as a consultant to Magellan and engages pretty regularly with the global PMs, but he stepped aside. We've brought in David George as a new CEO. David comes out of the Future Fund where he was deputy CIO. And David's been in place since August this year. With Hamish moving on, with the baton on the global equity strategy has moved to Nikki Thomas and Arvid Strymon. So they run the global equity strategy. Now, Arvid was working with Hamish before. He was a co-PM on the global equity strategy, and Nikki had returned to Magellan to work on that strategy. So it's not, our underlying process doesn't change, but the people involved in doing some of that work changes a little bit. So that's the essence of the changes that have gone on. Now, as part of that, whenever you lose a lead PM like Hamish, you do tend to lose some money. That we have some mandates with some large institutions where there was a key person clause in that contract, and that the minute that Hamish moved on, that led us to losing some money. That's never good. But in terms of what we're doing, it doesn't change. It doesn't change the way that we feel about what we're doing. And certainly in terms of what we do in infrastructure, nothing's changed one iota.
Thank you, Gerald. There's just been a little bit of discussion by the research houses around your change in role.
Yeah.
Can you talk us through that a little bit as well?
So that everyone understands, I've always had a sort of a dual role at Magellan, or a duality to my role, if you like. The bulk of my time has always been taken up on infrastructure, but I've always held, or for I think 14 of the last 16 years, I've held a title as head of investments, and head of investments has meant different things at different times, but I've always had those two things. That head of investments has been rebadged as deputy CIO, and the research houses have suggested that means that I'm, and the team, given the stuff that's gone on at Magellan, that we're at risk of leaving. I might, just to give people a feel for why I don't think that's a risk. First of all, I don't expect to be going anywhere. It's my intention to be here for the duration. I'm 55. I've got a long way to go in my career, and I'm quite happy where I am. So I don't see that that's a risk at all. And then in terms of my team, ultimately they've got to make a decision for themselves. But in the 16 years we've been running, we've never lost anyone in my team to a competitor, ever. And that doesn't mean that it won't ever happen. But, the team has always, it's up to them. I don't take that for granted. We have to make sure that their careers are challenging and they're doing good work and so on. But as I said, I think over 15 years, we haven't lost anyone in our team other than to retirement. The couple we had to move on for performance reasons, but we've never lost anyone to the industry. So, hopefully that gives people some degree of confidence. At the end of the day, it's up to us. Track record means nothing. We have to continue to perform for investors, and we have to continue to perform for staff. And that's my role to make sure that we do that. So it's up to consultants are always going to hold an opinion. Researchers, they've downgraded us sort of from highly recommended to recommended as a result of all of that. That's disappointing, but I understand where they're coming from. I'm pretty comfortable, as I said, that there are no major changes happening here, and it's certainly not my intention to do anything.
I'll make the point that the fund is still very highly regarded by the research houses in its universe, Gerald. There are very few funds in the infrastructure universe that have those ratings. I know you're not so consumed by the ratings, but it is something that we look at a little bit.
Yeah, no, absolutely. They're important. And the ratings, the researchers do a good job. I have a great deal of respect for, for all of them, to be honest. The ones that certainly that operate in the retail space in Australia. They ask good questions. They ask tough questions, and we have to answer them, and we go through what we're doing and why. So I respect what they're coming from, but I just differ in their opinion.
Good. We'll get into the exciting stuff. Now, infrastructure, it's a very, very generic term, Gerald. Can you talk about how you think about infrastructure, what it means in an investment sense, and how Magellan defines its universe in terms of infrastructure?
Yeah, so in your opening remarks, you talked a little bit about infrastructure and our fund being a diversifier for client portfolios. And that's generally seen as a key reason to invest in infrastructure, that it's different to equities and therefore it diversifies returns. And I always think of diversifying returns as, when you're betting on the Melbourne Cup, do you want to be on one horse or do you want to be in a box trifecta of, 8 or 9 or 10 horses? You're more likely to walk away with some sort of win if you've got more horses in the race. And that doesn't mean that you're always going to win, but collectively you give yourself a better chance. And that's really what infrastructure delivers, I think, to portfolios. There are it behaves differently to global equities and therefore, or to equities more broadly, and therefore it's going to diversify your returns. Now, how does it behave differently? It delivers reliable returns. Infrastructure is essential services. That's the definition. The slide we've got up there talks about essential assets. And those essential assets are assets that provide services that are essential for the efficient functioning of communities. So the provision of energy, the provision of water, the provision of transport. And our global universe, as Patrick's showing you there, is about 350 companies with a market cap of more than $4 trillion US. So about twice the size of the Australian Stock Exchange in terms of total market cap. To give you a sense of it, but about 350 companies. They're generally pretty large companies. So utilities, transport, social infrastructure. And that's the way that the investors generally define it by virtue of that term essential assets. At Magellan, we take another sort of leg to our definition. We start with that definition, and that slide there is on the left-hand side. We add the bit on the right-hand side, and that is that earnings are not sensitive to sort of external variables, commodity price, competition, sovereign risk. So in other words, you've got an essential asset providing essential service. That means reliable demand over time. As I said, we're pretty confident that those communities who have electricity are going to keep on turning the lights on every day, no matter what the economy does. You've got very reliable demand, but what we want to make sure is that there's nothing that comes along and plays with the cash flow. So we want to make sure that earnings and cash flows are reliable over time. And if we do that, if we get this part of our process right, definition, then we should be very confident that what investors end up with is a portfolio of very defensive assets with inflation-linked exposure, so the prices are linked to inflation, and so as inflation rises, so do returns. So you're not threatened by inflation, but also that you have low correlation with other asset classes. And that low correlation is the key to diversification.
And this is really why it's an attractive asset for including in a diversified portfolio, Gerald, that sort of comment down the bottom. Highly defensive inflation-linked exposure exhibits low correlation with other assets.
Yeah, exactly. It's about, I like to say that what we're doing, if we're getting definition right, is about delivering to investors a portfolio of highly boring assets. Their earnings just do what they're expected to do over time. The pandemic, throws some, and we'll talk a little bit more about that probably later on, throws some excitement into my life, but way too much excitement for me in the last couple of years. But under normal circumstances, we just expect earnings just to reliably increase at a slow rate, nothing too exciting each year. Because these are, people need to get around, they need to move around their community. So hence transport's reliable, energy's reliable, and they're going to keep on using water. So the transport of water is pretty reliable as well. So that's the essence of what we're after. We start with what everyone else says, and then we take this extra leg to it. And where that leaves us is about 130 companies. So I talked before about 350 companies in our universe.
Yep.
Total universe, there's 130 companies that we consider investment grade infrastructure, of 60% of which are utilities, about 40% of which are infrastructure.
And I think the next slide, Gerald, is a really good example of the things that many would include as being infrastructure, but Magellan doesn't consider infrastructure. So can you sort of focus on why you think some are and some aren't infrastructure in terms of that strict definition?
So this looks at electricity. As I mentioned already, once you've had electricity, it's pretty rare that people reject that. So it's a very much an essential service. Now, the way that electricity operates is there's four key parts of the industry. Generation, someone generates the electricity. You send those electrons down high voltage transmission lines. You step that voltage down into distribution lines, which in communities, which come into your home or place of business, and then someone sells you that electricity. Now, that first bit, generation, in Australia, the average price of electricity is about $90 a megawatt hour. Now, it differs from state to state, but it's about $90 a megawatt hour. Now, compared to that average price of $90, the maximum price is $15,000 a megawatt hour.
Wow.
And the minimum price is negative $500 a megawatt hour in spring when the sun is shining and the wind is blowing, but no one actually needs electricity for air conditioners or heating or anything. So at that point in time, the big electric companies are essentially paying customers to take the electricity away from them. So you've got this price that bounces around all over the place, and therefore revenues are not reliable and earnings are not reliable. So we don't want to be in generation. Transmission and distribution, well, no one wants two sets of poles and wires, so therefore they are natural monopolies providing an essential service, and therefore they're regulated. And for most investors, they think of when they hear regulation, they run for the hills. We run towards it. Regulation for us means that earnings are always reliable, because the way the regulation is framed is that the utilities are allowed to earn a fair return on their assets over time. So times are tough. They're allowed to put their prices up so that they earn that fair return. And the fair return is about 9%. So no, good or bad, they earn that 9%. So that's.
I know this is a different slide, Gerald, but this sort of talks to that regulation piece, doesn't it? The sovereign risk on particular assets.
Yeah. So if we think about regulation and sovereign risk, so sovereign risk is sort of the rule of law, but regulation and sovereign risk are really around what the officials can do to us. And here, one of the things we avoid is sovereign risk. We don't invest in China, we don't invest in Russia. And here's an example of why. This is a toll road, Chengdu Expressway in China, and we're comparing it with CityLink, Transurban's Melbourne toll road. You can see CityLink, the income is it's on an index basis. It's just gradually increasing each year. It's not too exciting. That's exactly what we expect out of infrastructure. Chengdu Expressway, the light.
I'm a bit upset when I get my CityLink bill each month, Gerald. I wouldn't say it's not exciting. Gets me a bit angry, but anyway.
Well, it makes me excited. I always like to tell my mates as they're wandering, I'm in Sydney, but as they're wandering through Sydney and they hear that beep on their, as they go through a toll booth, you think of me, you just put money in my pocket. So that's CityLink's Chengdu Expressways in China. You can see it starts, that lighter blue line starts with a very similar upward sloping curve, and then it starts heading south there. And then it heads south because back in 2011, the Chinese government decided that on 8 of the 11 national public holidays, that toll roads would be free. And that was because people go back to their villages. And that worked so well for them that the next year they went, okay, well, people are going to go to their village and they're going to come back again. So not on 8 days, but on 20 days of the year, toll roads are going to be free. These are 20 of the busiest days. And they then allowed a competing toll road to open next door to this thing. So income went down. Now, in their concession deed, the contract they had with the government, Chingu Expressway had clauses in there that said that in the event that the government instituted laws that impacted them like this, that they would get compensation. And indeed, if there was a competing toll road open next to them, they would get compensation. But they've never actually claimed that compensation, because I think they kind of like living in their homes and not in jail. So the essence of that is, this is not a jurisdiction that we want to invest in. It's got very attractive themes as it pertains to infrastructure. You know, the car ownership in China has grown at something like 10% per annum for about the last 20 years. So you build a toll road in China, you will get traffic. You just might never ever see any cash flow. And so therefore we avoid China. We avoid competition, we avoid China, we avoid Russia, we avoid sovereign risk. And then the third thing we avoid is commodity price risk. So commodity price risk is really around the oil price. And so what we're showing you here is two of the bigger companies, Williams Company and Kinder Morgan, who own big oil and gas pipelines across the US that connect oil and gas basins with communities. And what happened back in 2014, 2015 is the oil price went from $107 a barrel, sort of where it is now, down to $26 a barrel. As a result, you can see on an index basis, again, the share prices basically did the same thing. Now, these are good companies, but they essentially toll the value of the oil that goes through the pipeline. So as the oil price rises and falls, so do their revenues, so do their earnings, and then so do their dividends, and ultimately, therefore, their share price.
It's more like a commodity play than an infrastructure play, isn't it?
Yeah. So at the moment, we don't invest in these sorts of assets. And at the moment, these are fantastic investments. So it's actually hurting our relative returns at the moment. But we're just not in the business of actually having any view about what oil prices will do. And therefore, we avoid these sorts of companies. So we avoid commodity price risk, competition, sovereign risk. And this is what we do invest in, as I said before, about 130 companies in those three buckets. Utilities, three different sectors: water, gas, and transmission and distribution, or electricity. But that accounts for basically 60% of the potential companies we can invest in, about 40% in transport, about 1% in social. A market cap of about 2 trillion. So about the size of the Australian Stock Exchange. Smaller number of companies, but in total market cap size, about the same size.
Fascinating. Now, we've had reporting season both here in Australia recently, Gerald, and also overseas. And there's been a number of companies in your infrastructure portfolio that have reported. What are you seeing? Are the results good? Are the results bad? Are they stressed? How are things playing out for these businesses at the moment?
Yeah, so you have to think, if we think through our two major buckets, infrastructure and utilities. If we start with utilities, what we're showing you here is that the utilities pretty much across the board, we're giving you 21 results. So this is back to December last year, but it plays out now for the 9 months of this year. We're seeing results generally in line with or above guidance. So these companies utilities generally give you 5-year guidance. They tell you what they're going to earn essentially for the next 5 years. And the fact that they can give you such long-dated guidance tells you about how reliable that business model is. But notwithstanding that, they're all either meeting or actually coming in above those levels. And if we look over the last 2 or 3 years, the pandemic was a big shock for all businesses, including these guys. Again, over the last 2 years, they continued to meet or exceed their guidance. There are very few instances of companies not achieving what they said they would set out to achieve in this space. So these companies, very reliable earnings, very predictable, and if anything, performing better than what we expected. So that's the utility bucket. In the infrastructure bucket, so these are assets involved in the transport of people, goods, and data. So in here, we've got airports, we've got toll roads, we've got communications assets, we've got rail, and we've got energy, so pipelines that toll the volume of oil and gas. So in that space, again, companies are certainly doing better than they were last year. The communications assets that continue to perform very strongly, and they have for the last 20 years. The communications assets is about the amount of data going through networks. And if you think about your mobile phone and think back to 20 years ago, maybe you had email going through your phone 20 years ago, but that was about it. Whereas now you'll probably have, you will have YouTube, you'll have Google Maps, you may well have Facebook on your phone. You'll probably
You'd certainly be on Instagram or TikTok or something like that, wouldn't you, Gerald?
I'm not much of a social media sort of guy, but yes, I am on Instagram. I do have children, so I need to communicate with them occasionally. But I certainly have Netflix on there, and I have ABC iView and the like. So that video, that's very data intensive, and that has meant significant increases in the amount of data going through networks over time. And as we move from 4G current technology to 5G. 5G is gradually moving into place. That's expected to lead to about another 25% increase in the amount of data we use per annum for the next 5 to 10 years. So there's this continued increase in data going through networks, which means that communications infrastructure should continue to grow their earnings and their distributions, probably high single digit, 7, 8, 9%, something like that per annum over the next decade is what we would expect. So that, and those companies continue to perform in line with that. That's communications. Airports, we've seen some interesting things over the last 3 or 4 years. As I said, way too much excitement in my life. So with airports, what we saw was that back in 2020, in sort of March, April 2020, is that passenger numbers globally fell about 94.5%. There weren't too many people left flying anymore. And we've seen a gradual recovery since. So today now it sort of differs up by region. So we've seen, as I said, we're probably the numbers for September have only just come out, and then passengers are down 26% versus where they were in September of 2019.
Yep.
So we've seen a progressive recovery to that, but that you see very different things in different jurisdictions. So in the US, passengers are about 5% below.
Yep.
In Europe, they're about 15% below. In Asia Pacific, they're about 50% below.
Yeah.
But basically, China's not flying.
Yep.
So what we are generally seeing is that once markets open up, people want to fly.
Of course.
And they're coming back. And at the moment, they're coming back almost irrespective of price. And then if we think about the components of demand, there are 3 components: leisure, people going on holidays, visiting friends and relatives, and business. Now, business globally accounts for about 25% of aviation traffic, and it has been the slowest leg to come back. It's running at about probably 80%. Leisure has come back very strongly, and leisure destinations are generally running at 2019 numbers, if not above.
People are catching up, of course.
Yep. Yeah. And then the third bit, and then visiting friends and relatives has also come back pretty strongly, not as strongly as leisure, but pretty strongly. So we're quite comfortable that that's going to keep on growing, and we're going to continue to see continued growth in passengers, in particular as China opens up once they get on top of the pandemic. And we would expect to see those numbers get above 2019 numbers probably next year, late next year, assuming that we don't have a massive or a significant change in the status of the pandemic through that period. So where those numbers are coming back, the rate of improvement has been better than what people expected, and certainly better than what we expected. We didn't think we'd be back to 2019 numbers until sort of 25, 26. So as I said, it looks like we'll be back there in late 24, if not before. And it differs by jurisdiction. If I look at Mexico, the passenger numbers in Mexico are about 20 to 30% above where they were in 2019.
Wow.
So some jurisdictions doing better than others. To the extent to which you don't rely upon Chinese passengers, then it's come back very quickly.
Yep. Now, you mentioned before a couple of times, Gerald, that the last 2 or 3 years has been far more exciting than what you would have wanted. I couldn't agree more.
Yep.
It's an extremely challenging period for all asset classes. Even fixed interest has produced a negative return over the last 12 months, be it global or Australian fixed interest. But it's been particularly difficult for infrastructure, with things around interest rates and inflation and these sorts of things. So can you give us some context around the recent performance of the fund and why it's been a really challenging environment?
Yeah, so there's a couple of things going on. One is interest rates and inflation. I'll come back to that. And the second one has been oil prices. So the interest rates and inflation affect our absolute returns, and oil price reflects our relative returns, how we perform versus the index. So, for example, over a 1 year, you can see we've underperformed there by 3.5%, and that basically oil prices have cost us about 4 to 5% through that period. So the underperformance is essentially due to the fact we're not in the oil part of our universe. Over the 3 years, similarly, oil's cost us about 2% per annum. So that's basically that's the reason for underperformance. You still see that the index has underperformed through that period, and that's really about interest rates and inflation. Now, what we've found over time is that when rates move up by, let's say, by 1%, infrastructure tends to underperform in the short term over like a month or two by about 5 to 10%. So if interest rates go up by 1%, infrastructure falls by about 5 to 10%. And there are really 5 times over the last decade where we've seen rates go up by 1%. And on 4 of those occasions, infrastructure fell. There was back in the May, June 2013, what's known as the taper tantrum.
Yep.
And there was the election of Mr. Trump.
Yep.
In November 16. Then in 17, he put in place some tax reductions that people concerned were going to lead to the economy overheating. So each of those times, rates went up by about 90 basis points and infrastructure fell 5 to 10%. And the 4th time was March this year, where rates went up by about 1%. Infrastructure actually went up in that month. It went up by something like 6%, or our fund went up plus 6% in that month. And so we were a little bit confused by that, to be brutally honest. That's not what we expected. We expected infrastructure to go down. But essentially what was happening, people were getting worried about a recession and they were moving away from
defensive. Yeah,
exactly. They're moving to defensive, so that we ended up with a bunch of them in infrastructure. The flip side of that is come September, interest rates went up by about 1.4%. Infrastructure fell by about 11, 12%, something of that order.
So it was sort of making up for that previous.
Yeah, exactly. There was this overreaction. So if we look over the last year, the year to end of September, on a hedged basis, global equities was down 17.5%, as you said, not a way too much excitement. Infrastructure, or our fund was down 4.5% through that period, 4.7%.
So it's protecting capital well.
Well, yeah, we're not crowing about being down 4.7%.
No.
But it's basically performing as according to thesis. You're not getting the full hit of that underperformance from global equities.
Just to pick up on that interest rate, and I'm sure we'll talk about it later as well, Gerald, but I think it goes without saying that until interest rates started to increase, it's been the downward trend in interest rates has been a little bit of a tailwind for infrastructure. Are you and the team thinking about infrastructure assets differently in this higher interest rate environment, or is it business as usual in terms of how you look at these companies?
So I think to answer that question, we need to think about real and nominal interest rates. So everyone generally focuses on the nominal interest rate. What's the rate you have to pay at the bank on your mortgage? What's the central bank government bond yield? That's a nominal rate. We focus a lot more. We focus on that, but we focus just as much, if not more, on the real interest rate. So the inflation adjusted rate. So when nominal rates change, if the real rate doesn't change, it essentially means nothing for infrastructure. So in other words, if the nominal rate goes from, 4% to 5%, and there's no change in the real rate. So in other words, it's the increase in the nominal rate is just reflecting inflation. Inflation goes up 1%, the nominal rate goes up by 1%. Then infrastructure shouldn't move. It will in the short term over that first 2-month period, but history would suggest over the next 2 to 3 months, it'll actually come back to where it started. And we've actually seen some of that September, October. September, we were down, as I said, about 13%. In October, we were up 4 and a bit %, and we're up again in the early parts of November. And there's no real good reason for that, but that's investors seeing the long-term cash flow. So they'll come back so as much as nominal rates have fallen over time, and that gives you a bit of a sugar hit in the short term, or the flip side is when rates rise, it's a bit of short-term pain. Over the medium, not even the medium term, over a matter of months, normally infrastructure settles back to where it should be in relation to those real interest rates. So the big change that happened to us this year in September is that real rates went up. They went up by about 80 basis points. So as we move forward, how do we think about that? Well, we actually think real rates, which are running at about 1.5% now in the US and in Australia, we think that's a sustainable level.
Yep.
Or if you like, another way to say it is, we think the risk of an increase is equal to the risk of a decrease.
Yep.
And so those parameters are baked into the way that we value assets. We're valuing assets essentially on the basis of a 4% nominal rate and a 1.5% real rate. So which means inflation's the difference. 4 minus 1.5 is about 2.5% inflation, long-term inflation. So we think that's a fair basis for valuing assets. And on that basis, we can find plenty of things that look attractive to us.
Yep.
We want to be a little bit careful because we do expect inflation to hang around for another 2 to 3 years at least. And so we want to be careful about those assets that don't have as good inflation protection as some of our other assets. So toll roads, if you're driving down Transurban's roads, the tolls escalate automatically on the first day of the new quarter. So on October the 1st, tolls were up by roughly 6%. Toll rate. Fantastic thing. Fantastic.
Yep.
Maybe not for you, but for me.
No.
So we like that. For communications assets, which I talked about before, they have this massive volume thematic coming at them, but the pricing they have embedded is more fixed. So they typically have sort of 3% price escalators. So if inflation's well above 3%, they're not as good assets to be in. Now, it's not going to put them at risk of insolvency, but it will mean their growth in their underlying distributions won't be what it might be. So we're thinking about that in terms of the way we position the portfolio. We've reduced our exposure a little bit to communications assets. We've increased our exposure to toll road assets. A year ago, it was roughly 17% of our portfolio. Today, it's about 24% of our portfolio. And because that in an inflationary environment with traffic coming back, post the pandemic, we think they're pretty good companies to be placed in at the moment. So that's about a quarter of our portfolio. So it influences us, but it's not a massive driver of what we're doing.
Yeah, and this next slide just highlights that oil price story that you're talking about before, Gerald. And look, maybe not perfectly aligned with my next question, but sort of the issue around energy prices. Europe and many other parts of the world are definitely feeling the impact of surging energy prices off the back of sanctions against Russia, which is one of the world's biggest energy producers. What are the impacts of these escalating prices on companies, their customers as well, and how are the regulators reacting in those jurisdictions?
Yeah, so if you think about electric utilities, there's the energy they transport to you, and that cost of that energy has gone up. And then there's secondly, there's the transport cost. So we invest in the transport cost. So we invest in the poles and the wires or the pipes that bring gas or electricity to consumers. And the cost of that transport hasn't changed, essentially. The cost of the energy has changed, but not the cost of the transport. So to this juncture, we haven't seen any, there are regulators asking questions, but we've seen no remedial action or action against any of our companies, and we wouldn't expect it. Part of what I've talked already about sovereign risk, but one of the things we're looking at as part of that when we're analysing companies is the regulatory regime in which they work under. And in very simple terms, we expect the regulatory regime to have a set of rules, and we expect them to play by the rules. And so, for example, in that we invest into Italy, and Italy. I think most people would characterise Italy, and maybe unfairly, but it's somewhat chaotic when it comes to pretty much all things, but particularly
Had a fair few prime ministers over the last 100 years, Gerald.
It's a bit of a national sport, changing prime ministers. But their regulatory system has a set of rules, and they played by the rules. They played purely and fairly and squarely by the rules as really ever since I've been looking at Italian regulated utilities. So we feel quite comfortable investing in that environment. UK, Australia, US, very similar on those fronts. Spain is kind of interesting one, and we have invested in Spanish utilities from time to time when we thought they were cheap. But their rules are very flexible. No, I wouldn't quite say they don't have a set of rules, but they've got a very flexible view of what the rules are, and they don't necessarily play by them. So we're a lot more cautious around Spain than we are about other jurisdictions. But to go back to your question, undoubtedly the cost of energy is a problem for businesses, but for our companies that get a regulated return on their asset base, that return doesn't change, and we have seen no action out of regulators that would threaten those returns at this point in time.
Understood. Now, I want to swing back to airports. You did sort of introduce it at the start, Gerald, but I think you'd have to be hiding under a rock to not see all the issues sort of through parts of Europe in their summer, which they're coming out of now. All these issues about delayed flights and baggage issues. Just to sort of, are we getting closer to that pre-COVID normal for the airport industry?
Yeah, no, we're definitely getting very close. So this is what passenger numbers have done globally. As I said, you can see domestic versus international. So domestics come back more strongly. And again, the general message is those jurisdictions that opened up post-pandemic most quickly are the ones where you've seen passengers come back pretty quickly. All the airports and all the airlines for that matter, and like most businesses in the world, are struggling for workers at the moment. And that's led to some of those logistics issues. But they expect to be back to normal, inverted commas, in terms of staffing and so on, probably next summer. So in the Northern Hemisphere. So that's sort of June, July next year. So things are gradually approaching normal in terms of delays and the like, and they expect to be back to normal by next summer at the latest. But the passenger numbers are gradually moving back to where we expect them to be. And here, as I said, these are sort of the regional differences. You can see Asia Pacific's clearly the laggard. You can see North America the best performer, and Europe not too far behind. And again, US the best performer because it opened up quickly. They were the most skeptical, if you like, around the virus. They've opened up and things have happened pretty quickly. The grey bit in the middle is just there wasn't any data released for that period. But you can see the progressive improvement with the exception of Asia Pacific. And if you go to the next page, you'll see exactly what's going on. Oh, no, I haven't included it. Okay, so the bit in Asia Pacific that's not working is China. China's it's materially down.
And really in the US is that it's really people not traveling for business like they might have been before, Gerald.
Yeah, the business numbers are down, as we touched on before, three parts to the demand profile. But they're actually come back a little bit more quickly than certainly what I expected. I thought there'd be more of what we're doing today. There'd be more.
Yeah, Zoom, that's what I would think. Yeah.
And the like. But what we've seen is, people are quite keen to reconnect with their customers to do the face-to-face stuff. We would expect a reduction in internal travel. You're traveling to go and see colleagues. Yep. But for external purposes, particularly where there's sales involved, if your competitor's doing it, I think companies feel like they need to do it. And so that's the business numbers are back sort of 80-85%, whereas we thought it would take a lot longer for that to come back.
Or they've spent too much time at home.
Yeah, look, I actually think it's actually a pretty healthy outlook. Yeah. We expect to, we'll have to see how if there's a recession eventuates, and I expect it will. What that means, it might be, that might mute the demand growth, but we expect to be back to 2019 numbers sometime next year, really.
Now you mentioned the increase in toll roads in the portfolio, Gerald. I think toll roads is probably the asset that we get lots of questions about in terms of people working from home, how that impacts toll roads. So can you talk us through why you like toll roads at the moment, the traffic volumes, and also maybe touch on Transurban as well?
Yeah, absolutely. So there are two types of toll roads: interurban roads, which typically are roads that connect multiple towns and cities. And so the chart that we've got up there is Atlantia, an Italian toll road company that owns interurban roads in Italy, in France, in Spain, and also in Brazil. And so we're showing you the traffic, and I'll come back to that. And then we have urban roads, which exist in a single urban centre. So that's Transurban. So let's deal with interurban. So interurban, there's a bit of a higher degree of truck traffic because it's about moving goods between various towns and cities. So traffic here, you can see in April 2020 was down essentially 80%. Brazil, not quite as much because they didn't put the same restrictions on during the pandemic that other countries did. But in developed countries, basically traffic was down about 80%. It rebounded pretty quickly when people were allowed out again. But then as with the second and subsequent waves of the pandemic, it fell down to about 40% down on 2019 numbers. But you can see thereafter, you've seen a progressive recovery, and we're now running above 2019 levels in most jurisdictions. So we've seen with interurban roads, that traffic's come back pretty quickly. And that's not too surprising. Ultimately, traffic in a catchment is a function of two things: the number of people who live in that catchment and the number of businesses in that catchment. So for a period when you're all in quarantine, okay, you're not allowed to get around, so you don't have the traffic. But once you're allowed to move around again, ultimately traffic reestablishes itself pretty quickly. And we've always been pretty confident about that. And that's one of the reasons why we continue to hold positions in our toll roads over time. At the current time, in addition to which, because of the automatic indexation of inflation, and you've got volumes continuing to grow, so prices, what the tolls that people pay are connected to inflation, you get some volume growth as well. So we like the outlook for those assets, and we think that they're well placed, particularly in an inflationary environment. So Atlantia is an example of a company we have been in. We've actually just exited Atlantia. The family who owns that, the Benetton family, has joined with private equity to take that over. So we were forced, we were buying that 18 months ago at about a price of about €17. We started at 14, we ended at 19, but the average price was about 17. And that got taken over, whereas it'll exit the stock exchange this month at about 23.75 euro.
Hmm.
So it was a good investment. We're sad to see it go, but that was a fair price. So, and we've replaced Atlantia with another company called Ferrovial. We can talk about that perhaps a little bit later. Hence, the position in toll roads has remained about the same. So this is into urban roads. If we move to urban roads, and then we're talking about transurban.
Transurban.
And here are the traffic numbers for transurban. You can see the successive waves in different cities. Melbourne obviously had a deeper pandemic experience than Brisbane or Sydney. So it's been a little bit slower to come back in terms of traffic. But the traffic trends remain pretty optimistic and pretty bullish. We continue to believe that traffic's going to keep on growing. Traffic in an urban environment, we regard urban roads as the kings of infrastructure assets, because once in an urban environment, once you've got a toll road, you built the toll road because the free roads are full. And if the free roads are full, then the traffic's only, if the population continues to grow, the traffic's only got one place to go, and that is the toll road. So we expect that, with Australia continuing to grow its population at sort of 1.25%, that should lead to sort of maybe 3%, maybe a touch more in traffic growth over time on these major roads in Melbourne, Sydney and Brisbane. And on top of which you've got inflation. And in most of Transurban's roads, it's a minimum of 4% or inflate, a maximum rather of 4% or inflation. So if inflation drops below 4, you still get 4% toll road growth, which means you've got a high single digit, maybe low double digit revenue growth, but not too much growth in cost means, high single digit earnings growth over time with a high degree of confidence. So this is what we like. And Transurban's tolling regime means that quarterly you're capturing inflation along the way. So again, you've got inflation protection, you've got what we think is very reliable traffic. And we think this is an exceptionally well-run company as well. It's one of Australia's national champions, global champions, that is. They operate roads, obviously in Melbourne, Sydney, Brisbane, but they also operate roads in the US and in Canada. And we think they've got
Gerald, I don't think anyone could possibly think that volume has returned to 2019 levels. It's incredible, really, isn't it?
Yeah. No, and there's some things around that. So one of the, you mentioned before, working from home, people often worried about whether or not working from home will mean a reduction in traffic, and we probably think it will over time. And our base case forecast is that on average people will work one day from home. So then the question is, well, how much traffic is actually related to going to and from work? And Transurban have put out some data. I think that might be the next chart, Patrick, that shows that, no, it's not there. So the Transurban put out some data that shows that roughly somewhere between 15 and 20% of traffic each day is about going to and from work. So at the high end, if you say it's 20%, then you've got basically 1 out of 5 is what you're exposed to. So about 4% of traffic. So you could take a 4% hit over the long term. In the meantime, as I said, traffic is essentially back to where it was. Melbourne, it's a little bit below, but it's not far off. And the outlook remains pretty positive. So we think this is, as I said, a fantastic company, provides us the sort of reliability of returns we need and really good inflation protection.
Yeah. And just to revert back to your comments earlier, Gerald, about the changes that you've made in the portfolio in recent times, this is the sector and geographical exposure of the fund at the moment.
So the sector weights haven't changed too much. We're roughly 50% infrastructure, 50% utilities. There's a little bit of cash, which throws the numbers out. But we're roughly equal weight to the two major bits. Utilities on the left there in the orange and yellow segments of the pie, infrastructure in the blue and the grey. What we have done is trade within what we're doing. So we've moved out of Atlantia, I mentioned before. We've acquired about a 4% position in Ferrovial, and Ferrovial owns a 25% interest in Heathrow Airport and a 40% interest in the 407 electronic toll road in Toronto, Canada. The 407 is, we think, the world's most valuable asset in infrastructure land. And why? Well, it's about 100-kilometre toll road, cut into 36 different sections, and with the possibility, it's not 8 lanes all of that length, but it could be. It's got the capacity to build into it, 8 lanes in either direction. And on those 36 different sections, they can set tolls wherever they want. They can have different tolls for different sections. And you won't really know when you're driving down what the toll is, because they can change it as and when they need to. Now, that road, the 407, competes with the 401. 401 is the busiest road in North America. It also is 8 lanes in each direction. And it basically, the peak hour starts at sort of 5:30, 6 in the morning, and holds the peak through the day. So normally most roads, you don't find too much traffic on the middle of the day. There's not the peak is sort of 7 to 9 in the morning and 5 to 7 at night. On the 401, the free road in Toronto, it's at peak hour all day long, essentially.
Wow.
So the average speed on the 401 is 20 to 30 kilometres per hour.
Sounds like a fun road to be on.
Yeah, exactly. It's the sort of road you want to compete with. By comparison, the 407, the average speed is 100 kilometres an hour.
Goodness.
So you get the sense this one's a much better proposition for consumers. Now, on the 407, they can set tolls wherever they like. So think about Transurban, they're limited to 4% or inflation. On the 407, they can set tolls wherever they like. And so that's an incredibly valuable proposition. And so that company, they own 43% of the 407, and that accounts for about 2/3 of the value, in our view, of Ferrovial. So Ferrovial owns toll roads, airports, but the major toll road asset is the 407. The major airport asset is Heathrow, London Heathrow, and they also have a construction business, which is about 10% of their earnings.
Yeah. Just and to flick back to the stock that is recently subject of a takeover, Gerald, is that becoming? Yeah, is that becoming there's a massive thirst from something like a future fund, these really big sovereign wealth funds, even our big super funds here in Australia, to acquire these infrastructure assets, take them off the market and make them private. Good for you guys if you get a takeover offer. But is this something that you see as a trend that will continue, or how do you think that might continue?
Look, I think that's been going on for about 20 years. Basically, pension funds and super funds really like infrastructure assets because they match very well with their liabilities. That is their earnings expectations at inflation +5, and that's generally what their liabilities are. So they're fantastic assets for them to be invested in. What we've seen over time is that periodically they've acquired some of them, typically in times of duress. So Sydney Airport got acquired by a bunch of super funds post the pandemic because their share price was impacted by that. But they've taken a view that their long-term prospects are not impacted by that. So when that dynamic happens, from time to time, there'll be assets that get acquired. If I was to go back, and there's certainly been a bunch of that over the last 15 years. Well, I joined Magellan 16 years ago, and there's been a bunch of that over that 16-year period. But the flip side is there's also been new assets come into the space. So 16 years ago, we had roughly 150 companies in our universe. Today, there's 140 companies in our universe.
Government doesn't want to pay for this stuff, do they, Gerald?
No. So there's new things coming in. There's some things that will go out. I don't think that's different. The key theme will be privatisation. I don't expect a lot of privatisation, but we do expect an uptick in it. Basically, all the governments in the world now have a public sector debt problem. They're having paid out big time through the pandemic. So we expect there to be some privatisation to help in funding their public sector deficit, and that should lead to more opportunities for us over time.
Now, we've spoken about a couple of stocks, Ferrovial, which you just mentioned before, the 407, spoke about Transurban. I want to pick on one in the portfolio here, which is, I'm going to try it, Aena, which is Spanish airport. Now, I must say, Gerald, I can't remember the statistics around this, and I can't remember whether it was the GFC or the European debt crisis, but there were some ridiculous statistics around Spanish airports in terms of the number of airports in Spain per person. And I'm not sure whether that sort of rectified itself, but what is it that you like about Aena?
Yeah, so Aena is this Spanish airport system. They basically own all the airports in Spain, not all of them, but the bulk of them. And I think there's 46 different airports that they own in Spain. They also own Luton Airport in the UK, and they own some airports in South America, in Colombia and in Brazil. But the bulk of their operation is their Spanish airports. And what we like about Aena is I talked before about demand, about leisure, visiting friends and relatives, and business. Business is a very low component of what they do. It's about 10% of their passenger mix. It's really dominated by leisure. It's people going to...
Not a bad place for a holiday.
Yeah, exactly. And so that's... we're quite confident about the nature of that over time. So we think that it's got very reliable demand over a long period of time into the future, and they've done a very good job of reducing costs over time. So we really like that opportunity set. If you think about Spain, the three biggest airports they have, or the three biggest passenger profiles, are Madrid, Barcelona, and Mallorca. And now they have, as I said, 46 different airports in 3 different buckets of A, B, and C. So we're really focused on the A buckets. The C buckets are not, they probably wipe their face, but they're not making a lot of money. So it's really the big airports there that are doing well, but they're particularly exposed to that leisure thematic, with not a lot of, and the bulk of that leisure is short haul. It's people coming from Europe, particularly the UK, to holiday in Spain. And so we think that that's a fantastic opportunity. Of our 7% in airports, about 4% sits in ANO. It's the one that we're most confident on as we move forward.
Interesting. Now, by far the easiest question of the day, Gerald, an outlook for the portfolio, an asset class, the crystal ball, so to speak. And I know we've sort of teased out some of these issues in the last 45 minutes, but can you give us an outlook for infrastructure as you look forward?
Yeah, so we think it's priced quite cheaply, not super cheap, but quite cheap at the moment. So we talk about expecting sort of inflation +5. We probably expect inflation +5 plus 2 or 3 at the moment over the next 5 years, but It will depend upon interest rates. I've talked before that we think interest rates are sort of finely balanced at the moment. There's as much risk to the upside as the downside. But if real rates were to grow by another 50 basis points, to go from 1.5% to say 2%, that would cost us 5% in valuation. So we think our portfolio is trading at about a 15% discount to fair value. That's our view of the world. It's not universal truth, but that's what we think. And so if rates were to go up, real rates, another 50 basis points, that 15 becomes 10. We would need a 1.5% increase in real rates to 3% for that to become fair value. So we think it's kind of an attractive environment to be investing into infrastructure. And we think the returns are pretty robust. Nothing, as the pandemic has shown us, nothing is ever bulletproof. But we think the returns are very robust and very predictable and reliable. And we would expect an investment to do kind of well over the next 5 years. Now, ultimately, we're always going to be a hostage in the short term to what the world throws at us.
Of course.
But if we take that longer term views, ultimately share prices will reflect the weight of cash flow, and the weight of cash flows here is pretty strong. So we think it's reasonably attractive at the moment. Not the most attractive we've ever seen. The most attractive we've ever seen was just after the GFC. But it's reasonably attractive, but we will have to focus on what happens to rates. Now, rates don't impact the businesses themselves too much. This is what we're showing you here. With utilities, if interest rates go up, they just pass it through. They go back to the regulator and they get that increase in interest rates passed through. With transport, the pricing, the tolls on a toll road automatically move with inflation. So you're protected from that. And these guys have then, if you think about their balance sheets, have raised very long-term debt. So a decade ago, we would have said the average debt maturity was sort of 3 years. They've locked in their debt costs for the next 3 years. These guys these days have locked it in for about the next decade. And you can see this.
Really.
Vinci back in May 21, so a year and a half ago, I guess, raised 10.5-year debt at 0.5% per annum. It's almost giving it away. So on average, they're probably paying 2.5-3%, and they'll probably be doing that for the next 3 or so years. And then their rates that they're paying will gradually increase, probably at 10 or 15 basis points per annum is what we'd expect over time. So they're well protected on a fundamental basis, but it doesn't mean that necessarily the market will reflect that. So this is the fundamental story. The next part is, what does the market do? And what I've already talked through with you is that when rates go up, we do get a hit. We expect to get a hit. We didn't in March this year, but we generally expect to get a hit. But it also comes back to us with a high degree of confidence.
Good. Beautiful. Thank you, Gerald. Really appreciate your time today.
No problem, Patrick. Thank you very much.
No worries at all. Thank you for presenting to our clients, and may the next 12 months be far less eventful than the last 3 years in the infrastructure space.
Exactly. I'm here for boring.
Take care, Gerald. All the best.
Thanks a lot, Patrick. Cheers.
Bye-bye.